Today in this video, we're going to talk about why people with great credit and high credit scores, like over 700, 800, still get denied for a mortgage. Check it out. Hi, I'm Rhonda Burgess. I'm a real estate broker and mortgage underwriter here in the Nashville, Tennessee area, and my firm is Southern Living Realty Partners. Okay, this one's easy. This one is quick. I get this call a lot because people do half of their homework. You know, I'm big on do your homework, do your homework, do your homework. Get ready. Don't just wake up today, whatever day it is, and say, oh, I'm going to go buy a house today. No, it's more of a process than that. You need to do your homework. Make sure your credit is straight, your money is straight, everything. You may need to even work on your credit score for a little while before you even go apply. But people just be in such a rush and everything. Oh, I got a 700. You know, you checking your Experian every month or whatever you're using, because, you know, whatever credit scoring model that you're following, whether it's your, you know, Advantage score, your FICO, 8, 9, 10, whatever, right? So, and I see this all the time. So people, you'll have a good credit score. Let's say you got a 730. Cool. You got a 730. You may have been on your job for a year or two, and in your mind, you make good money. And you may actually make good money. And then you go and apply for a mortgage, and it's a no from the giddy up. It's a no from the start. The main thing that messes up people, whether you have a high credit score or not, is your debt to income. It is your debt to income. And there's only two ways you can fix that. Either you need to reduce your debt because you're over the debt to income limit. You're over the ratio. The computer is screaming. The desktop underwriter is like, oh my, what? You got like a 60% on the back end. No. Okay. You're either way over and you need to bring your debt down, or you need to increase your income. Those are the only two ways really to fix your debt to income ratio problem. Okay. And I think a lot of times what happens is people don't understand exactly what all is counted in your debt to income ratio. I know y'all know how I beat this dead horse right here. When you co-signing, you're not the co-signer. You put that car in your name. Really, you became the primary borrower because your boyfriend, girlfriend, husband, sister, friend, them, your kids, somebody, your mama, your grandmama, them, somebody couldn't qualify for this car, right? And so they come to you because you got good credit. They come to you because they know you got good credit, right? Well, I couldn't get it, da, 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 da. And they are so bad that they can't even be the primary and need a co-signer. You end up being the primary borrower. So that becomes your debt. That becomes your debt. When you are the primary, you're the primary borrower. That is your debt, 100%. No, you cannot exclude that debt by showing the other person is making the payments. No, you're the primary borrower. That's your car. I don't care if you tell me 15 times, you know, that's your brother car, that's your mama car, that's your whoever car. I don't care. You're the primary borrower. That's your debt. So your debt DTI is jacked up. You have, I find a lot of times these people with these high credit scores, for some strange reason, owe taxes. You owe the IRS, or you owe your state some income taxes. And so it may not be showing on your credit report. So you thinking you look good, right? No, because listen, when we underwrite a file, there are so many systems that we run you through. We run your social through. We run your name through. So there's a system called SAM, System for Award Management. This is where we have to put in your information to see, do you owe other parts of the government? Do you owe the IRS? Do you owe your state? Did you have an old SBA loan that you didn't pay for? There's so many things. So it's a lot of times about, you don't think that's your debt, or it's some debt that you done thought that you didn't have to deal with, all kinds of stuff. The only time we can exclude that debt, like on the car loan, is if you are the cosigner and the primary borrower. Make sure that primary borrower is paying that bad boy on time every month. I see people who they don't follow up on that themselves, right? So you just relying on that person to make the payments. Okay? They ain't got nothing to lose. They got the car now. You see what I'm saying? They got the car now. They ain't got nothing to lose. So they don't really be, pressed about it. So if they late, they late. If they don't pay this month, oh well. Because that's how they've been living their life all along, because that's why they need a cosigner. Hello? That's why they got a low credit score, because this is how they handle their business. And you know this. And you're not following up on it. And then you come in and you're just shocked that your credit score has been taking a hit because they haven't been paying the payment. The only way we can exclude that payment, they've got to be the primary, and they really need to be paying it by check. They really need to be paying it by check or directly coming out of their account. So then we can see that, yeah, they are paying it and they are the primary. You are just the cosigner. You're the backup. So then we can exclude it when we can show that that person has been making those payments. And then sometimes people will come in, yeah, my cousin, she been making the payments. But we pull the credit, we pull the payment history. It ain't on time. It ain't, or they 60 days behind, or they whatever, or it's out for repo right now. What? No, that's not going to work. That's not going to work. Some other stuff I see, people may have a high credit score, but you got a judgment on you because you've been to court for something. It may have been a long time ago, but you got a judgment out there. We can't do nothing until that judgment's paid for in full. And that judgment will affect your DTI. Because say if it's a large judgment and you have made a payment arrangement, let's say you had a car accident and you owed $20,000 and you've made an arrangement to pay $200 a month. Yeah, that may not show up on your credit report, but that judgment is sitting out there. And then we're going to have all the paperwork on that judgment. And that's when you're going to say, oh, I made a payment arrangement. I'm paying that down, or I'm paying $500, $600, $700 a month, whatever. And so then we've got to go back and put that into your debt to income ratio. And it blows your ratio. Just because you have a good credit score does not mean you are credit worthy. Let me say that again for the people in the back. Just because you have a good credit score does not mean that you're credit worthy. I'm just telling you, you may not be credit worthy at this moment, right in time right here, to get a mortgage. You may not be. So again, you've got to check your debts, and then you've got to check the income. Because if your debts is up here, you need to get your income up here. They don't need to meet. This is if it's meeting, you're not going to qualify because you do not have enough residual income. You do not have enough money left after you pay your mortgage and your bills. You don't have nothing left. That's not going to work. So you're going to have to get your income up. And I'm sorry, we are underwriting, traditional underwriting. From your Fannie Mae, your Freddie Mac, which is an FHA, conventional, VA, everybody. The underwriting is still behind the times. Meaning, so you drive Uber at night, you do DoorDash at night, and you've been doing it, for some months. You've been doing it for a year. You still, in order for us to count that money, you still going to have paid taxes on it. and really done it for 2 full years and filed it on your tax return for 2 full years before we can use that money. Now, there are other types of programs you could do, like a bank statement program where it just goes off of your deposits each month. But what you need to know about a bank statement program is there's 12 months, there's 24-month bank statement programs. So what you would do is you would bring in your bank statements, like if it's going into your business checking account or your personal checking account, because like if you're just driving Uber or whatever, that would go in your personal checking account more than likely. Okay, cool. So then they take those deposits for the last 12 months. They take all of your deposits, added up, divided by 12. That's your income that we're going to use to count as far as your mortgage is concerned. Yay! I know you're thinking, yay, okay, cool, that's cool. Because now you've gotten that gig money in. You've gotten the side hustle money in. But the problem you have with a bank statement program, I've never seen one go higher than 85%. So that means you're going to put 15% down of the purchase price. So again, if you're needing a 100% loan financing, like a VA, if you're needing 96.5% financing like a FHA, or you need 100% like we get on USDA, if you're needing those programs that have little to no down payment, you can't use bank statements. That won't work. We can only get that money in through tax returns, and you got to have a 2-year history. Let's say you're doing the gig economy full time. Let's say you drive for, who am I trying to say? Like Amazon. Like you do the Amazon, not the blue truck people, but you know, the individual drivers who do the last mile deliveries. Still gonna need to have, if that's your full-time gig, whatever, you still gonna need 2 years worth of tax returns. The underwriting is still very much behind because it assumes that everybody is working a W-2 job like how it used to be. I'm personally a proponent for, we need to update underwriting guidelines to truly reflect what people are making right here, right now. You know, but those are the two things that you're going to have to look at. This is the reason why why some people with this high credit score still get turned down, and it's all because of the DTI, the debt to income. You either need to reduce your debts, make sure that you ain't dragging along somebody else's debt, make sure if there's some old debts you already took care of that. Double check your stuff. You know, that not every debt will show up on your credit report, but it will come out in the wash. So you need to make sure that you already account for those things. And then number 2, the second thing you need to do, or the other thing you need to do, is get your income up. So this is why I say you can't just wake up today and decide you're going to buy a house. Because if you need 2 years worth of tax returns, you should start on this 2 years ago. You should have got in your mind what you were going to do and started working on your plan 2 years ago. Do you see? Because we got this 2-year thing going on. And even if you were doing a bank statement program, a lot of times I've seen, there are 12-month bank statement programs, but most of them are 24 months. Do you see the 2-year thing still hanging over your head? It's the same difference. So make sure you've gotten all your ducks in a row. You've accounted for everything. Also, if you've taken loans, like from your 401k, from your retirement, and it is actually a loan, so it is on your check stub as a deduction, and you have to pay it back yourself, please know that that payment counts against your debt to income. So this is another point why I'm saying your debts be out of whack sometime, even though you have a very high credit score.